So let me start with the first slide. There are two kind of study material slides. One is basically focused on interview questions. This is something which is focused on interview. In the first hour, we will cover about the fundamentals. What are the applications for what is your scorecard, life cycle, sample design, setting up Python, population with decision segmentation, missing value treatment, treatment success. So we will go into this, and the second material is PowerPoint, which is made by me, and that one made by my team. Second one. So let's start with this one. So this is how a scorecard look like in practice. So we seg we divide the age into different categories, and these categories are called attributes up to 26, 26 to 35, 35 to 30. These are the scorecard points 100, 120, 185, 225. Gender, what are the points for male, what are the points for female, and what are the point for this much salary, what is the point for this much salary. So this is how a scorecard will look like. Let's say cutoff is this. If somebody comes with the application, age is 32. 32 basically means 120 points. Gender is female, 180 points. Salary is 1150. This is 160 points. 460 points. So you need 500 points to get the approval. So in this case, you will deny the application. So this is how a credit scorecard look like. Any question? Anyone? I think you have clarity on this. I will not get into this. This is a loan approval process. So there will be some basic criteria like somebody should be greater than 18 years. He should not be in default. He should not be bankrupt. He should not have some fraud. He should not be unemployed. Based on this criteria, you decide whether he has basic qualification to get the loan. And then you basically do the scorecard thing with him and see whether he passed the cutoff. If he passed the cutoff, then we check whether he passed the policy rule. If he passed the policy rule, you accept. Second option is there are some customers who are border case. For instance, if somebody gets 490 and the cutoff is 500, in that situation, what you want is want to consider a override. Override means exception situation. So if you say exception situation qualify for somebody, he will go here and policy will be checked and will qualify. Otherwise, he'll be rejected. So this is a loan process. Any question on this? Policy rules basically are very specific to banks, and different banks will have different policies. So question, why we use scorecard format for lending? First thing, it's very easy to understand, it's very easy to explain, it's very easy to implement, it's very easy to use. And somebody asks why he has been rejected, why she has been rejected. You can explain it to him, you can explain it to management, you can explain it to auditor, you can explain it to decision makers. No black box, everything basically is visible to you. Other thing that is important is, can you diagnose if something goes wrong with the scorecard? It's possible. Can you track what went wrong and why it went wrong? Whether the population changed, whether income level change, or what went change. So scorecard makes it very easy to track. Development process is standard. It has been developed since last 30 years probably. Scorecard, and so it's very easy to understand. There are kind of scorecard, application scorecard, which is also called acquisition scorecard, and there are behavior scorecard, which is also called account management or customer management scorecard. With the application scorecard, uh, it's a more about denying credit or giving credit, setting up the upsell or cross sell, product upgrade, product downgrade. So, based if somebody is your customer and that customer comes and take one product from you, based on that particular history which you have for that customer, you will give him other product. You'll try to cross sell something to him. For instance, somebody has a business account or personal account. You want to offer him credit card. That is cross sell. Then you want to set ATM limit, how much you can withdraw. You want to optimize the decision workflow, underwriting process, payment terms, regulatory capital. There is a capital which regulator asks you to keep to save yourself from a situation where customer default. That particular capital is called regulatory capital. And when customer want to renew the credit card or he want to increase the limit, then you use behavioral scorecard. Or for collection also you use behavioral scorecard because you have the history of the customer. Any question at this point?
So this course will be only limit to the acquisition and behavioral also is part of this.
I will go what kind of scorecards are there further. 1 minute. These are
Okay.
the different kind of scorecards.
Hmm.
So some will be application, some will be behavior, but categories will be only two.
Hmm. Correct.
So you have transaction fraud scorecard where you use fraud in fraud management, and application fraud scorecard which you use normally in insurance application, and then you have repayment scorecard which you use in bank loan or credit card, etc. Then you have scorecard for how much amount is recovered. Then you have scorecard by whether collection should be outsourced or collection should be done your with your team. Whether you should write off, for that also you have scorecard, and you have bankruptcy scorecard whether it's going to bankrupt. You have DPD indicators like 30 DPD, 6 DPD, 90 DPD, propensity to resolve, that kind of a scorecard. And then first time you need to figure out whether customer will pay or not. That's also you need a scorecard. Scorecard are basically based made for customer, not just one scorecard. It will be for different segments. Segment could be based on the product like mortgage, auto, credit card, loan, SME sectors, LTV, urban, rural, clean data, new data. So these are different kind of scorecard example. Any question, Partha? You're expert.
Yeah, yeah. That's okay. So, you do you have experience on across all these, or yeah, normally you used to create on generic wala?
I didn't get you.
So, do you have experience on all these scorecards? Have you created all these scorecards earlier, or how it is? I'm talking about your experience.
My experience is mainly in credit risk. Credit
Hmm.
risk means Basel, IFRS 9,
Okay.
and scorecard are part of Basel and IFRS 9 both. So those
Hmm.
kind of scorecard I have built. Other thing is like I'm also an entrepreneur. So we are building a fraud solution for transaction fraud. So we build a scorecard. And for cyber fraud, we build again something like that. And then we have uh, anti-money laundering fraud. For that also we build something very similar to scorecard.
Okay, AML also you're doing. Okay,
Yeah.
fine.
And then we have built a product for insurance accounting standard IFRS 17. IFRS 17 is basically a standard which insurance company has to follow everywhere in the world. So we build a product there also.
Okay.
So yeah. So my
So you have
experience,
a fair experience on this. Okay.
yeah.
Mm.
So the kind of customer are which are thin file customer where we don't have trade information. New to the book customer, customer with only bureau information. Thin file customer, new book customer almost similar because difference only you have bureau data on some customer. Otherwise you don't have anything for them. Existing book customer and then there's soft inquiry. Soft inquiry means that it won't be make any entry in the credit file for you if you do the soft inquiry, which bank itself knows how to do. They ask for some information, they don't ask for all information. In the hard inquiry, they ask for the all information. So it makes a record. There is a situation where if you make lot of inquiry, your credit score goes down, like hard inquiries, because then they take that as a negative. This is one of the parameter in the credit scorecard. The kind of product are secure versus unsecure. My experience predominantly is on the secure product or corporate product or wholesale product like mortgage or corporate loan or interbank lending or intercountry lending in UK. Auto loans, uh, I did something there for fraud. Revolving product, credit card product, I had touched some document there but not worked. Personal loans, I worked. Credit card again. Revolving product means they revolves. So scorecard design is one of the concern which you have in the beginning. You don't build a scorecard right away until unless you know who are the target customer for the scorecard. That is first thing. What is the target segment in those customers and which data you're going to use, which cutoff you're going to use. Most important thing you want to know what is the purpose of your scorecard. Whether you want to increase the acceptance rate, keeping the same bad rate, or you want to uh, reduce the bad rate, or you want to improve the profit efficiency or decision making process. So the people who will be involved in the scorecard developer, it could be one of you, project manager, product manager, risk manager, operation manager. There's a big team there who basically will be coordinating with you. When you make the scorecard decisions, like you're doing some outlier treatment, you will ask the expert whether this is a genuine outlier, whether this is a outlier which basically can be treated. So genuine outlier you need to maintain, and outlier which basically are not normal behavior, you need to treat them. So question arise like what is genuine outlier? Outlier means genuine outlier means it's a typical customer behavior which you don't expect. So there's a huge team who will answer your questions when you build the scorecard. Until unless you do it yourself, you will not understand the process completely and you will not enjoy it completely. Once you start building it, you will start enjoying it because challenges are there. Every day you solve one challenge, you move to the next challenge. That is a scorecard story. In the past, there used to be expert based lending, like based on the character, based on the capacity, based on the capital, how much you have, what kind of collateral you can provide, what kind of condition you can accept. They used to lend. And this has gone for centuries until the typical scorecard came. This typical scorecard came with the machine learning, data mining. This is how look like the expert based scorecard. One thing I want to tell you, in the wholesale lending, we still have expert based scorecard because there are so many qualitative indicators. There are two kind of indicators, variables: qualitative variable, quantitative variable. Quantitative variables give some idea, but lot of the things come from the qualitative variable, which basically are judged by experts. And those experts are paid huge amount of money by bank like HSBC, bank like Barclays, bank like UBS. So this is example of expert use scorecard, where you say industry position for the business, market share, geographical diversity, diversity product, customer mix, manager quality, executive board oversight. These are kind of thing you say, what is the score for this company? Based on this score which is come here in the town, you will decide whether disqualifying according to the decided cutoff for lending or not. Any question, Partha, Tishla, Omir? Okay. So categories are only two: behavior or application. Behavior scorecard are used. I think I will not go again to this story again. I just discussed. So when you build the application scorecard, you have known good, bad. It's called KGB. Known good. You build a scorecard on that. You insert the reject inference in there, and based on the reject inference, you combine the rejected data with the original data, and you build a scorecard again, and you do scaling and assessment, and then you validate. This is the application scorecard process.
So I wanted to ask something. This known good and bad. Does this mean that the variable is already variable is already there? Like what do you mean by known good and bad?
Known good but and bad means variables are there, but target is not there.
Okay.
Known means target, you know the target.
Okay.
And rejected data means you don't know the target.
Okay.
So what happens in this situation is like through the door population is something which basically customer comes, some are rejected by you. Once you reject them, you have their data, but you don't know what they would have done, whether they would have defaulted or they would have basically stayed good. So target is unknown for those customers. But the customer you accepted, within 1 year, you will see whether they defaulted, whether it stayed good. So they are known good and bad customers. Does that answer the question, Krishna?
Yeah. Yes.
On the behavior scorecard side, you make a scorecard with the known good, bad. and you don't do any reject inference, or you build a scorecard, you do the scaling, you do the assessment. One of the question which Artha asked me, why we decide the PDO 220 for building the scorecard. There are multiple reasons for that. One reason is you want to be close to the standards. You don't want to answer too many questions to the regulators. That is one reason. Second reason, if PDO is low, then when PD change, probability of default change little bit, there will be too much jump in the point. On the other side, when PDO is high, when PD change, it will change very less in the score. So PDO is related with the PD change. So you want to make sure that it's stable and it doesn't jump too much, it doesn't too little. So you want to get close to the standard. So you have option to experiment whether it's not jumping too much or it's not changing very little. Does this answer your question, Partha?
Somehow it is, because I have seen the challenge that I am getting sometimes is the data having the imbalance rate is so high. So in that case, setting the PDO at 20 is very difficult.
You
Because
can you can try, you can see the relationship with the PD. What you need to do is you need to plot with the PD different change. Like if you change PD from 0.1 to 0.2, no, 0.1 to 0.2 is very big change. 0.1 to 0.13, you change little bit by 0.01%. What
mm,
kind of impact it's there
because the
in the
concentration, if you are keeping 20 as a PDO, the concentration is so high. It is not distributing across all the score.
yeah. In that case, you can decide to go lower because recommended range for retail is 15 to 25. For corporate, I think it's something else. For mortgage, something else. You need to check the best guidelines. And
Well,
I won't be able to answer this question to you. What is the exact number we should use for the scorecard? Because for each case, you need to do this analysis, PD versus,
but, but that analysis is part of the course, right?
yeah, that
Yeah.
particular analysis is not part of the course because it takes a lot of extra effort on data.
Okay.
Yeah. But cutoff is part of the course because cutoff is very important. And I didn't expect your question before. If you would have put your question 1 week before, probably I would have included it.
Okay. Okay.
Yeah. So these are the variables which are used in the scorecard. Customer characteristic, which means demographic variable. Behavior characteristic, which means how much customer balance maintain and what is the utilization of the loan, and how much is the minimum balance, what is the maximum balance, what is the trend. So you basically see the customer behavior trend in those variables. Good bad flag, application is characteristics basically are age, income to debt ratio, those kind of which are very personal to the customer, which means they will vary from one customer to another customer, but behavior could be similar between customers, but application will be different. Application characteristics will be different across different customers. Transaction characteristics, Loan specific variables such as LTV, long term, loan balance, guarantee, bureau variable, time attendance, inquiry last month, delinquency. These are something which are bonus variable which you get from the bureau in addition to this to build the behavior scorecard. So normally you go with this and this for building the application scorecard. For building the behavior scorecard, you go with this and this. Any question on this? I want to have as much discussion as possible so that you get best out of this particular discussion. So bad definition depends on the product specification, credit policies, and Basel requirements. So that is something one. And then you have development sample, validation sample, rejected sample through the door population, and each sample will have number of observation. You have sample window, you have outcome window. Sample window means observation window. An observation window means during that you have some status. Based on this status of this variable, you do the prediction for next 12 months based on the outcome in next 12 months. Okay, this is what scorecard is all about. So performance window is described by regulators like you should maintain 1 year observation window. Sorry, 1 year performance window. It could be 12 months, it could be 18 months. And then you have this observation point. This observation point, it could be 18 months, it could be 12 months, and then you have maximum outcome period. Like from the this date, you see the outcome window from here to here, how long it takes from one point to another point to reach this decision. You want to include the all the 4 seasons, like you want to include winter season, how customer behave, summer, how customer behave, rainy season, how customer behave, again in the October, how customer behave. So you want to have sample points across quarters, or if you have a lot of less data, you can go across month. But if you go across month, there will be a lot of duplication. So you want to go across quarters only, depending upon what kind of scorecard you are building.
Sir, I have a small confusion in this observation window and performance window. So basically, like with respect to both scorecards, application and behavior. So behavior, I get it that we will observe the loan for some point of a time, but for application scorecard, how the observation window and performance window will be, and also when the data is like the two different kinds of data, panel data and cross-sectional data is there. So in cross-sectional, there would be no concept of performance window and observation window, right?
See, for the application scorecard, you have normally demographic data, which is a application, which is the customer data. Plus you will have bureau data. Bureau data means you want to have history of at least 1 year or 6 months minimum before you can basically build a scorecard. So you want this period to be at least 6 months, for which you need bureau data, right? Otherwise it will be thin file customer if you don't have history. Are you getting my point?
Yeah, so you're saying that for application one, 6 months bureau data, that is like the observation period.
Minimum 6 months or it could be 1 year, depending upon customer's requirement and recommendation from the expert in the team, like how they have built the PVC scorecard, depending upon their recommendation. Normally, for performance window, there will be minimum outcome period, which will be described by regulation. For instance, RBI will tell you that for this product, use this kind of performance window. It could be 12 months, it could be 18 months, depending upon that. For instance, in UK, if you do default, it will be 3 month arrears. In US, it's 6 months arrears.
Okay.
So,
Okay.
so depending upon which geographic location you are, outcome window will differ, observation window will differ.
Okay.
Are you clear about it, or you still have doubt?
Just one small thing. So, for example, if it is an application scorecard, and okay, we have, suppose it's not a thin file customer. The customer has a lot of, he's taken loans before, so that is why we have good enough data for 6 months. What about the performance window for application scorecard? Like, um,
It is normally 12 months.
okay.
Minimum
So,
12 months. Minimum 12 months you want to see for the application scorecard. For behavior scorecard, it could be 6 months. Just 6 months.
okay, so for example, if suppose we are choosing a performance window of 6 months or say 12 months, and if there are certain loans in the application scorecard who the entire tenure of the loan is less than 6 months, less than the performance window, then do we take out those loans?
I think if it's a 6 month loan, then it will be different scorecard. Basically, depending upon the vintage analysis, depending upon the roll rate analysis, you will basically decide the performance window.
Correct. So that's the, it is not uniform across all.
Yeah,
So it depends on the behavior of a customer or product.
yeah. You need to document your analysis in such a way that auditors are convinced, regulators are convinced, and customer are convinced if they ask to the court why my application was rejected.
Okay, and so when we have cross-sectional data, then there is no point of any observation window and performance window because we have just one row per customer, right?
Yes, ideally you should have multiple entries for one customer across different points to make the utilization variables, like how much utilization has been done in 6 months, how much utilization has been done in 3 months. So normally they are called trend variable and they are used for behavioral scorecard. For application scorecard, you will have normally cross-sectional data, which means if you take the bureau data, you will convert that into the cross-sectional data, which means one row per customer.
Okay.
Yeah. Okay. So you had definition like current. At the moment, you are no delinquency, and normally you see the first 12 months and next 12 months. Next 12 months, like how behavior from 13 months to 24 months, if this is a performance window. How is the performance between this month to this month? This is again 12 months. This is observation window. So you have current. Current means currently no delinquency. For 3 months there is no delinquency. So you can decide if it has gone to current. Suddenly he go and do again go into arrears. Again second month, third one, again here he become default. Again here basically he pay. So depending upon the customer behavior, you will decide whether to include them in the sample or not in the sample. So this is one of the consideration which you need to make when customer data is with you. I'm telling you about the data preparation I know I'm not doing it because you should know you will work with the data team. And when you work with the data team, you want to ensure that they you understand them, and when you talk their language, they feel more happy that you know what is going on in their kind of department. So there is something called vintage report. So vintage report means you said that how you decide about the observation window, performance window. So for the performance window, this is the answer. So these are different vintage. When the bad rate gets flat, you want to take that kind of period for performance window. Any question, Trishla, on this?
No, sir.
Okay.
But
So
here, one challenge will come. So let's say you will first fix the bad, or you'll fix the performance window. So that's the question.
the question is whether you fix the bad first or you fix the performance window.
Ah,
Bad definition will be there first. Based on the bad definition, you will decide whether this is a bad or this is a good. Performance window will be something which is related with the once you define this is bad, whether this bad is happening in this period of time. After that, you decide when this bad rate becomes stable. That bad rate becomes stable is your performance window definition.
but let's say there is a product called housing. In housing, normally, because it is a long tenure product, and normally people's or customers start defaulting after 24 36 months.
Mhm.
So now the question is, can I create a scorecard? Let's say the flattening of whatever rate you are telling your bad rate is happening after 36 months. So do you feel our performance window will be 36 months?
36 months, ideally, if you can justify to the regulator what you are doing, it should be okay. It should be okay. Because you will say, I
Because
have, you will
36
say,
too
I
long,
don't have,
right?
no, no, no. Let me answer. You normally, typically, customer are A, B, C, D type. And you say their performance window is 12 months. But I have customer of X, Y, Z who take long to mature and decide whether they default or not. So my performance window will be 36 months. And this is my vintage analysis. This is my roll rate analysis. And I had done this analysis over last 10 years. If you come with that kind of analysis, then you should be okay.
But for application scorecard, a period of 36 months will be little higher, right? Because
It, doesn't,
eventually you are trying to.
it does not matter whether it's a high or low. If regulator had defined that 12 months is there, you will use 12 months. If you want exception from the regulator, then you need to give them roll rate analysis for 10 years. You need to give them vintage analysis for 10 years. Convince them that I XYZ customer who chose different behavior. That's why I'm using this for my customers, because other analysis does not apply to me. It's not suitable for my customers. So I'll tell you, credit risk world is beautiful world, and you can do anything as long as you can convince the customer with a data story. Does that answer the question?
Yeah, because you sometimes what will happen, even if you think, when let's say in same housing example, if I'm going back and checking the 36-month other performance window, eventually we are trying to say ki the expected bad rate on the application scorecard is within 36 month the customer will get default. So 36 month when you will tell to the product team, then definitely they will come up ki 36 is too long. So eventually I
The,
have to delivery as early as possible.
you want to know that 36 months is too long.
Hmm.
So I had told you that you need to talk to the multiple stakeholders during the scorecard building process. That are you okay with this outline treatment? Are you okay with this bad definition? Are you okay with this performance window? So you need to take multiple stakeholder in consideration when you build a scorecard. It's not something which you will do alone. So you will look at the sales, you look at the customer, you look at the regulator. So based on that, you will decide. So if you can convince them this is how it works in vintage, and they are okay with that, you are fine. So this is how looking roll rate. They are convinced with that, you are fine. But you need to convince them strongly based on the data analysis. Not only one person, at least 10% you need to convince when you go differently in the customer in the when you basically do something different, you need to convince different customers. If you're doing normal thing, then you are fine. Like you said, 20 PDO is too high or too low. Then you need to convince the customer, all the stakeholder, that I'm going to use 25 as a PDO. Is that okay? So these are the kind of challenge you need to face. And as long as you're growing the business after building the scorecard, you're reducing the default rate, you will be fine. But if that thing goes wrong, then particular problem will come to you. Why you had done this and how you had done this. Good point, Partha.
Okay, okay, okay.
Yeah. So bad definition example, you can plot it by bad rate by month open cohort and see where basically customer get stable in terms of bad rate. There's something called probation period. I haven't talked about. Like normally, once customer default, you give him 12-month period to uh, come out of it and stay clean. Once customer come out of the 12-month period, then he will basically consider clean. You know that, Tashra, right?
Yes, sir.
Okay. So different default definition, you will try 30-month days, you 60-month day, 90-day past due. In IFRS 9, if somebody go past 30-day past due, he switch from one stage to another stage where you do the lifetime calculation. But here it might not be significant thing. It will be one of the things, just one of the things where you want to decide whether you want to go for a collection after 30-day past due, if it is going to be lost, or 60-day past due, or 90-day past due, depending upon what kind of customer it is. Charge of the write-off, bankruptcy, claim, insurance claim comes, then you consider customer bad, or profit is not coming, revenue is not coming, amount collected is not coming, then collection scorecard basically decide whether. So these are different definition of bad, and you use roll rate technique. You use vintage analysis. All this is part of the data preparation. So you need to be very good with all this. They're not rocket science. You read name Siddiqui, you'll see this is one time learning you need to do, and you can apply it again and again and again. So this is role rate analysis thing. I will not go for this one. I'll go for this one. So this is 12 month here. This is 12 month. If somebody is the current, what are the chances he will get 30-day past due, he will get 60-day past, he will get 90-day past due. Somebody is 30-day past due, what are the chances he'll go again 30-day past due? What will go 60-day past due? So as soon as you go from one delinquency bucket to another delinquency bucket, 30 to 60, 60 to 90, bad rate will basically, roll rate will basically change. They are more likely somebody who has gone 90-day past due before is likely to go 90-day past due again here, like this. This is 12-month history, and then this is month-wise. Somebody in the previous month is like this, in the current month how it behaves. So let's say somebody is currently, he will stay current. Somebody more likely 89%. Somebody is 30-day past due, he will stay current 78% time. Somebody is 60-day past due, nearly 11%. And then this is, sum this two, basically whether he going to reach here again. So this is example of roll data analysis. Any question?
So can you just tell in this what should be your bad if this is the case?
What should be the
Bad definition.
is bad
Essentially
definition?
the flow rate analysis you're doing to define your bad, right?
Yeah. So in this definition, you see that current almost stay normal, right? 30-day past due, 78%. And 90-day past due, 93%, he will basically default again. So you want to maximize this number. When you want to maximize this number, you will go with that number where you get maximum outcome. So in this case, my roll rate will be 90-day past due because my number remains almost exactly same. This is more point of stability. If I'm 90-day past due, I'm going to be 93% there. Make sense?
Okay.
So somebody asked me what to include, what to exclude. So good, bad outcome within 12 months included. Good less than 12-month outcome excluded. Bad less than 12 outcome included. Migrated to less than 30, 60-day past due excluded. Migrated to 61 plus 3 past due included. So This is one example, like what to include in the data, what to exclude in the data. Okay, so I will go more deeper into this. These are the customer exclusion. This is taken from name Siddiqui, not rocket science. So there are customer who default at the observation point. If somebody is in default, you will exclude him. If somebody is part of the policy exclusion, like bankrupt customer, no loan to employed, fraud, write-off, you will exclude them. Loan with sufficient, without sufficient history, intermediate, indeterminate, is also excluded. Loan without this much balance, insufficient usage, is also exclude. Inactive and voluntary cancelled account, these are again excluded. Insurance account with a claim under a specific currency value, these are also excluded. So bank employees also excluded from the scorecard because they know something in and out. So this is how a typical process look like scorecard population. You have 150,000 customer, 90% customer basically 10% only will go for basically your scorecard because of these exclusions. And out of 10%, two-third will basically will have known history, one-third will have reject inference. Out of reject inference, policy reject will be 66%, and sample scorecard reject will be 33%. So this is how we're going to use in the reject inference this particular number, and this is you're going to use in scorecard, good and bad, and this again you want to exclude. So when you build the scorecard, your population goes down from top to bottom to down to down to down. So this is why we have less data when we build the scorecard. This is definition of good: never declared delinquent, never past due, no claim, paid up or closed, profitable, no fraud, no bankruptcy, recovery is greater than 75%, must be good throughout the performance window. This is example of intermediate. I think this is again from Naeem Siddiqui, so you might have read it. So once you have sample, you will have one sample in time sample, one out of time sample. In time sample means same time frame sample. Out of time means different time frame sample. So here you will take two parts, one for model testing, one for building the model. You will have two parts, model development, model validation. So this is more like dividing sample into multiple parts to test it multiple times. If you exclude this part, then also it will be fine, but these two, three, it should be there. Any question, Tishla, part, Om?
No, sir.
Yes.
Data availability, number of good and bad. So what name Siddiqui says, that you should have 2,000 bad, 2,000 good, 2,000 reject. And you should have as much as internal data. It's more reliable. And sometimes you need to outsource the scorecard to the third party. When you need to outsource to the third party, in that situation, you basically you don't have the data. If you don't have the reliable data, you don't want to build a scorecard. You want to build a scorecard only on the policy data, on the bureau data. Like company like Experian and TransUnion, they sell that scorecard and you use them. So when they run the bureau, they do this in addition on the customer request. Let me talk about segmentation. So what happens in the case of the customer? They don't behave similarly across different age, across different gender, across different income, across different profession. So you need to segment them in different, and you need to build different scorecard for them. When you segment them, objective is to create the homogeneous group, and for one homogeneous group, you make a scorecard. This scorecard is for this particular population between, let's say, who people are working as a senior managers, who are working, who are female, who are male. So depending upon application where it's not considered discriminatory, you will build a scorecard based on a segment. For doing segmentation, you use techniques like decision tree. So segment can be based on the product, it could be based on the loan type, secure, unsecured loan, lease finance, used or new, brand depending upon demographics, geographic, channel, application or account type, new or existing, depending upon different kind of, all sort of ideas can come when it comes to the segmentation. When you make segments, you don't only think about historical of record, you think about future. Once you detect the segment, whether this data will be available in future, whether this bad rate is real indicator of a segment, or this bad rate is not indicator of a segment. Because at the end of the day, you want to make segment only to improve the performance of the scorecard, and you consider bad rate one of the parameters. How is the bad rate between different segments? And you want to improve the approval rate, you want to improve the profit. Example of segment: young versus old, demographic split, tenor and bank. So these are again same kind of slide. So bad rate example, like age is less than 30, 2.1%, 4.6%. A segment 2.9. If you make one scorecard for them, you will not get a homogeneous population, because these guys who are greater than less than 30, they are going to default more. When they default more, it's going to be problem for your scorecard. Performance will go down. Residential status, rent, own also will have same kind of difference. Parents who stay with the parents will have same kind of difference. So one question to you, Parth. Have you done segmentation for building different scorecards?
Yeah, normally we on first attempt we try to build on entire population itself, and if you feels there is a variation, the coverage of the bad on the scorecard is on holistic, the first one. If it is not coming out correctly, then we used to do the segment. But the segment, the challenge that we used to face is your data, definitely the target segment will go down.
That is the biggest problem is segmentation, whether
Hmm,
future data will be available or not.
correct.
So I did not understand this point. This future data available or not for segmentation. I did not get this point.
The point here is you created a segment like for instance less than age 30 people and greater than age 30% people. Suddenly what happens is less than 30 age people start going to different lender. They don't come to you because you don't have attractive scheme for them. So you start losing customer. When you start losing customer, uh, your data will go down. So if you don't have future data or future data availability guarantee, better not to segment. That does make sense.
Yeah, I get it. So, practically, how does it happen? For example, this is a part of like when we are doing the exploratory data analysis. Before that, or as a part of that, we'll have to do the segmentation. How would we know how, like, how many segments we need to make? Like, do we have to do some statistical analysis for that, or do we have to see the distributions? Like, how do we come to know what kind of and how much segmentation we should do?
Uh, as a I have built a scorecard where I have run the decision tree for doing the segmentation. After doing the segmentation, I have built scorecard, not the scorecard. I'll say I run the heuristic regression on those score segments to see the performance on the raw data, not the WE transformation. Ideally, you need to do on the WE transformation that kind of logistic regression run, which I run, and see whether your AUC go up, whether your approval rate goes up. So those kind of decision are something which are part of the segmentation exercise. It takes probably 1 month, 2 months just to do the segmentation and convince the customer you're doing the segmentation. If you're not doing the segmentation, also you need to convince your stakeholder why you're not doing the segmentation. And here, marketing and operation department play the key role because they know how customer behave differently across different customers, across different segments. I'll show you that. Okay.
Okay.
So, so you check the AOC for the segmented scorecard and for AOC for the one scorecard and say the approval rate and bad rate comparison. For instance, here AUC is 0.65, 0.69, improvement is 6.15%. Here, less than each, approval rate is 65%, and bad rate is 4.1%. When you do the segmentation, I think you have more. 1 minute, I think I forgot which one is segmented, which is not segmented. This should be segmented, I think. When you do segmentation here, bad rate goes up. Here also bad rate goes up. So you will not do segment basically because of bad rate going up. Approval rates remain same. On the tenor one, you see their approval rate is 55%. This is 6.2. And here bad rate has gone down after segmentation. On the other side, bad rate has gone up from 2.1 to 2.9 after segmentation. So ideally, you will see what is the overall bad rate. Then you will decide whether bad rate is dropping or bad rate is coming with staying same, depending upon you decide segment on this or not. Then here also improvement is there in the AUC, but whether there is an improvement here, bad rate has gone up, bad rate has gone up here also from 3.27 to 3.8. So we will not do the segmentation based on this also. So these are the decisions which basically help you decide whether segment or not. You will need to build the whole scorecard again statically and show to the stakeholders on each segment whether to segment or not. You might have done this, Partha, right?
Yeah, that is
Okay.
and also used to check uh, on feature importance. Any new variables are coming up. If I'm doing the segmentation and if I'm not doing segmentation, so technically that talks about ki there are certain elements are there. If I'm going with a single approach, I may miss out.
Hmm.
Or maybe there are some feature which is very dominating on nature, hence others features are not coming up. So if I'll do the segmentation, so definitely other influencing variables will come up.
Hmm. One of the thing is when you do the segmentation, like whether that particular variable is available in the future or not. That's what you
Hmm.
said, right? That
Correct.
that matters a lot. If you end up doing segmentation on something which is not available, your whole exercise has gone waste. So you need to talk to market expert, operation expert, whether this will be available or not. So this is one of the things. So why there are multiple factors whether to do segmentation, whether you can build so many scorecard or not. What is the build cost of building a scorecard? What is the processing cost? What is the implementation cost? What is the monitoring and strategy cost? What is segment size? Then it makes sense. If segment is too small, I think you will not do it. So these are the factors based on which you decide whether to do segmentation or not. I will not do this. This is example from our own scorecard, which we will work, and I will give you this data after 2 sessions, and you will have freedom to play with that data also. So ideally, you create homogeneous group after segmentation. Here in this case, when error month is less than 0.216 and entropy, 1 minute. 1 minute. So entropy will go down, I guess. Yeah, it will go down. And when entropy go down, it becomes more homogeneous group. But you need to see whether sample size is too small. Here sample size is too small, so you will not consider this one. Here sample size is this one. and after that sample size again goes down. So you will reject this one also, and you will reject this one also, you will reject this one also. You will go only with this particular segmentation because you don't want too small sample. Does that make sense, Partha?
Yeah, yeah.
Okay.
But
So
for so when you will create a decision tree, so you
yes,
will play around with few variables, or how you will decide which one you have to take into consideration for decision tree building.
you will play around with variables, and ideally decision tree should give you variable.
Mhm. So, is there any threshold limit that normally people follows on X or Y percentage of bad should be there? Then I'll consider the segmentation. Or
I think there is some recommendation on that. Let me check whether I have it.
2000 you mentioned
Yeah,
on this slide.
yeah. So 2000 is not there in this one, right?
Uh, but eventually, uh, for a portfolio which is not matured 3 4 years book, so there 2000 odd you will not get.
Thing is, if you look at the sample in the top,
Hmm.
we have highly unbalanced sample,
Hmm.
and we are building a scorecard on this.
Hmm. Still you can.
Still, you can.
Hmm.
The only reason I rejected this one because sample size is too small,
Hmm.
not the bad rate.
Hmm.
Bad rate is not something which should stop you from building the scorecard.
Hmm.
And there are techniques which basically work on low default portfolio.
Hmm.
So that should not be a problem, I guess.
So you mean the bad count at least should be around 2000.
If you want a beautiful scorecard, you should
Uh,
have that kind of bad rate or bad count.
hmm.
But if you want to make a scorecard, you have to it. Then this is what we are going to do in this exercise, and this is what I'm going to show you. We don't have any fixed criteria how much bad rate should be there, how much bad rate should not be there, because bad rate can go down to any level. In this case, I think bad rate will be approximately, this is 720 to 20, 1 by 20, 0.05%. 0.05% is too low, right?
Yeah, yeah. But
Yeah, but
our case it is we have to build.
yeah. And we have, if you look here, in the, yeah, here, we have beautiful gain curve. What is AOC? AOC is also good we have. I'll show you tomorrow. I'll run it and show you one by one. Okay. I will not go into this segmentation by decision tree because this is the only option which I prefer, and this is the industry standard practice, and you can explain to the business easily. easily understandable. This is why we use decision tree for segmentation. Then we have missing value treatment. Missing value could be either random or it could be basically unintentionally or it could be related with default rate. So three kind of missing value are there. So depending upon what kind of missing value it is, you will decide whether to just impute or whether create a missing value indicator or do something else. So there are three strategies for missing value. One is delete that particular observation. Second one is keep it, treat them as separate category. Third one is replace with the non-value. For continuous variable such as balance, will replace with mean. For another continuous variable, will replace with median. For ordinal or nominal variable, did somebody raise hand? I heard some voice. For ordinal or nominal variable, we will use mode or modal value, which is such as gender. For that, you will use mode. One of the thing about missing value is if you are replacing a variable with mean in training data, then you need to replace in the validation data with the same mean, the missing value. Or you're replacing somewhere with the mode in training data. With the same mode, you need to replace with the invalidation data. So those things you need to be careful. You can use k nearest neighbor technique. You can use linear regression also. This is a code which basically I had wrote for missing value treatment. Shall I jump into the code now, show some code to you, or do more?
So could we take a 5 to 10 minutes break? Is it possible?
What do you say, Partha? Are you okay with the break? Partha, are you here? Amish, shall we take break for 5 minutes or 10 minutes?
I am good, whatever you take break or whatever you continue. It's up to you.
Partha, you are okay? I think Partha is on break itself. Okay, guys, we will basically take 5 minute break. We will assemble at how long you need, Trishna? 10 minutes?
Yeah, sir. Yeah.
So we'll assemble at 10:25. Okay.